Facebook year to date has been quite the case study in investor psychology, crisis management, and how the market interprets those events. And if we think back to earlier this year when the Cambridge Analytica scandal was happening, Facebook, which had been this wonderful high flyer, and not without good reason, the earnings growth has been terrific, the revenue growth, et cetera. And it's insinuated itself into people's lives in a way that at least for many people, certainly not their whole user base, but many of them find it, if not indispensable, something that they use on a daily basis. And when I say Facebook, I'm referring not only to Facebook but to Instagram and to WhatsApp and some of their other items. The Cambridge Analytica scandal definitely took a big shot at investor psychology. I think people had a sense that Facebook had certain flaws, and they really hadn't wrestled with the implications of them becoming such a meaningful part of the world's dialogue, and that shook people, and that was perceived as initially something that could really put a cap on Facebook's growth and on their prospects. And then the buy the dip psychology took hold. People definitely. The Cambridge Analytica scandal hit at a time where the market was probably less sanguine about a lot of things, more risk averse. Then the market became a bit more risk friendly over the past few months, and Facebook became a market leader again. And I think that's really where the most recent problems stem from. It wasn't necessarily that they said anything different in their latest earnings release than we'd been hearing from them, but I think investor psychology got so far ahead of itself. Now, was that fear of missing out? I think that's definitely playing into it, where you have a situation where the market leadership concentration has become ever more narrow. And I hate to overuse the FANG terminology, but when you really get into, let's call them the FANGs plus a few, that's really where so much of the market leadership has come from. So if you're an active investor, if you really have to mark yourself against your peers, not just against your own performance desires, you have to. You don't have to do anything, but you have a certain incentive to being invested in these high-flying names. But it doesn't take much when investor psychology gets so far ahead of itself to throw it off track. And that's what we saw first with Netflix, and secondarily, to a greater degree, with Facebook. There are still plenty of great reasons to be looking at these stocks, not necessarily from a valuation point of view, though. If nothing else, when the trade war type of rhetoric was going back and forth, a lot of the FANG names were perceived as being largely immune. For starters, Facebook is essentially blocked in China, as is Google. So you're not missing much by not really doing anything in China there. And so that psychology permeated. The question now becomes, where do we go from here? I actually thought that the market performed rather well on the day that Facebook took its 20% haircut. If you told me that there would be some event that would wipe out call it $100 billion in one fell swoop from people's accounts, the fact that the market otherwise was, meandering, it was actually somewhat of a positive sign. Last Friday, we kind of had a bit of an ugly close with the market selling off through the afternoon, but even then, the S&P was up on the week, so you're not really seeing a real flight to the exits yet. We'll see where that takes us, but right now, I think that the Facebook and to some extent the Netflix results show that investor psychology may not be as willing to accept everything thrown their way. Investors have definitely shown a bit of skittishness, but that seems to be still on a more stock-specific basis than market overall dynamics right now. We'll see where that takes us. That can change in a hurry, but that's my read as of the moment.